Imagine this. You wake up one morning to headlines screaming about collapsing banks, plummeting stock markets, and governments scrambling for solutions. Families are withdrawing their savings in panic, businesses are shuttering overnight, and the streets are filled with uncertainty. This might sound like a scene from a dystopian movie, but could it become our reality in 2025? In this video, we'll unravel the fragile threads of the global economy, explore the factors pushing us toward the edge, and identify practical solutions that could steer us away from disaster. Picture this. Nations borrowing at record levels, stacking IOUs that may never be repaid. As of 2025, global debt has surpassed an astronomical $300 trillion. To put this in perspective, that's nearly 4 times the world's total GDP. Countries like the United States have seen their debt-to-GDP ratios climb above 130%, a level historically associated with fiscal crises. For developing nations, the story is even grimmer. Take Sri Lanka as an example. Its government defaulted on loans in 2022, leading to mass protests and political upheaval. Today, over 60% of low-income countries are at high risk of debt distress. With interest rates rising, servicing these debts is becoming unsustainable, and the threat of widespread defaults looms large. Let's step into the shoes of an average household. Imagine the price of groceries doubling within a year. Eggs, milk, and bread are no longer affordable staples. This is the harsh reality for many families across Europe and the United States, where inflation has remained stubbornly high, averaging 6 to 7% in recent years. Central banks, like the Federal Reserve, have responded by aggressively raising interest rates. While this cools inflation, it also slows economic growth, making borrowing more expensive for both consumers and businesses. High inflation coupled with stagnant wages has eroded purchasing power, creating a cost-of-living crisis in many parts of the world. Imagine a world divided by sanctions, trade wars, and military confrontations. The ongoing Russia-Ukraine conflict alone has wiped out over $1 trillion in global economic value, according to the World Bank. Meanwhile, tensions between the US and China, two economic superpowers, are disrupting global supply chains from semiconductors to energy markets. These geopolitical disruptions are not just theoretical risks. They are reshaping how businesses and governments plan for the future. Investors are pulling back from volatile regions, and international trade growth has slowed to under 2% annually, compared to the historical average of 5%. Now, imagine a farmer in California struggling to grow crops during an unprecedented drought, or a family in Bangladesh displaced by rising sea levels. Climate change is no longer a distant threat. It's here, and it's costing the global economy over $500 billion annually in damages. In 2023 alone, Hurricane Ian caused $113 billion in losses in the United States. From agriculture to infrastructure, industries worldwide are grappling with the economic fallout of extreme weather. This added strain further limits governments' abilities to address existing financial challenges. Think back to the 2008 financial crisis. One of the main culprits was the housing bubble. Today, similar patterns are emerging. Real estate prices in cities like San Francisco, London, and Sydney have reached unsustainable highs. According to a recent report, over 40% of urban properties in these regions are overvalued by at least 20%. The same is true for stock markets, particularly in tech-heavy indices like the Nasdaq, where valuations often defy traditional metrics. A sudden correction in these asset classes could trigger panic selling, destabilizing the broader financial system. As central banks raise interest rates to combat inflation, they inadvertently increase the risk of recession. Higher borrowing costs mean that fewer people can afford mortgages, leading to declines in housing markets. Similarly, businesses face challenges in securing affordable loans for expansion. The International Monetary Fund, IMF, has warned that aggressive rate hikes could shave off up to 1.5% of global GDP growth in 2025. While this may seem small, it translates to billions of dollars in lost economic activity. Regional banks in countries like the United States and Italy are particularly vulnerable. In 2023, the collapse of Silicon Valley Bank sent shockwaves through the tech sector. Analysts fear that similar bank failures could trigger a domino effect, as smaller institutions often lack the reserves to weather economic shocks. For developing economies, the risks are even more pronounced. Weak regulatory frameworks and overexposure to volatile currencies make their banking systems ticking time bombs. While technological advancements promise greater efficiency, they also bring disruption. Automation has already displaced over 20 million manufacturing jobs globally. By 2030, up to 30% of all jobs could be automated, according to a study by McKinsey. Without adequate retraining programs, millions of workers could be left behind, exacerbating income inequality and social unrest. The global energy transition is a double-edged sword. While renewable energy sources are crucial for combating climate change, the shift away from fossil fuels has created volatility in energy markets. For instance, lithium prices, critical for electric vehicle batteries, have surged by over 400% in the past 2 years. Countries heavily dependent on oil and gas exports, like Saudi Arabia and Russia, face significant economic challenges. Meanwhile, energy-importing nations struggle with rising costs, which stifle growth and fuel inflation. Governments can learn from nations like Norway, which has successfully diversified its economy through its sovereign wealth fund. By investing oil revenues into technology, healthcare, and education, Norway has built a robust economic safety net. For individuals, diversifying income sources, whether through freelancing, investing, or starting small businesses, can provide financial resilience. Platforms like Coursera and Udemy offer affordable courses to help people acquire in-demand skills, making it easier to adapt to changing job markets. Countries like Canada have implemented nationwide financial literacy programs in schools, equipping young people with the knowledge to manage debt, save effectively, and invest wisely. Expanding such programs globally could reduce household financial stress and improve overall economic stability. History shows that collaboration works. For instance, the Marshall Plan helped rebuild Europe after World War II, creating decades of prosperity. Today, similar efforts are needed to address shared challenges like climate change and trade imbalances. Global institutions like the G20 must take the lead in fostering cooperation, ensuring that no nation is left behind. Governments should prioritize projects that withstand climate change and economic shocks. Examples include flood-resistant urban planning in the Netherlands and energy-efficient transportation systems in Germany. These investments create jobs while securing long-term growth. Countries like Finland have shown how investing in education pays off. By focusing on STEM, science, technology, engineering, and mathematics fields, they have created a workforce ready for the future. Public-private partnerships can also accelerate innovation, ensuring that technological advancements benefit all. The global economy stands at a crossroads. While the risks are significant, so too are the opportunities for renewal. The next few years will determine whether we succumb to crises or rise above them. Policymakers must act decisively, prioritizing long-term stability over short-term gains. For individuals, the key lies in staying informed, adaptable, and proactive. Together, we can build a future that is not only resilient, but also prosperous. As we navigate these turbulent times, one question remains. Will we learn from history, or are we doomed to repeat it? The answers lie in the actions we take today. What do you think? Are we prepared to avert a financial meltdown, or is the world headed for a new crisis? Let us know your thoughts in the comments. And don't forget to like, share, and subscribe for more insights on global economics. Together, we can make sense of an uncertain world.